Hi everyone, it's Brian with Stockcalc. In this short video we're going to go through the weighted average cost of capital tool that's available on the free site for Stockcalc.com. To access the full site and to try a demo of it, simply click the Try Stockcalc Now button and provide your email address. We will forward you an email with instructions to demo the full site. In the weighted average cost of capital tool, you see the different components: beta, cost of equity, cost of debt, cost of preferred, and overall weighted average cost of capital. So the easiest way to do this is to use an example. I'm going to type GE into the text box and select General Electric from the drop-down. It'll load the index, so we can use the Dow or the S&P in this case. We'll stick with the Dow. And it does an automatic calculation of beta. Beta is the expression of how we expect the underlying stock to move compared to its index. So in this case, if the Dow goes up 1, we would expect GE to go up 1.3. Conversely, if the Dow went down 1, we would expect GE to go down 1.3. We're using a standard 60-month time frame to do the calculation and comparing it to the close price. Once we have the beta in place, we can calculate the cost of equity. And we can actually do two calculations. We can do a build-up method, or we can do a capital asset pricing model. So using the risk-free rate, the equity risk premium, the industry size and company premiums, we calculate using the build-up method. Using the beta multiplied by the equity risk premium plus the risk-free rate, size, and company premiums, we calculate the cost of equity using the capital asset pricing model. You can see the various risk premiums that are available here, and we've pre-populated them based on the company characteristics. They're all available for editing. So for example, if we thought the industry risk premium was much higher, we would see the changes that would impact on, in this case, the build-up method. Cost of debt is calculated based on the financial statements. So we take the interest paid from the income statement divided by the total debt from the balance sheet and reduce it by the taxable amount to come up with an after-tax cost of debt in percentage. If the company has preferred stock, we would also calculate the cost of preferreds as the dividend percentage. Dividends divided by preferreds outstanding. Finally, the weighted average cost of capital tab allows us to pull all of this information together. So you can see, for example, for GE, based on all of the information that we have, if we use the capital asset pricing model cost of equity, we use the cost of debt that was generated previously, no preferreds, and a breakdown of the equity value, so this is the actual market capitalization of the company, compared to the book value of the debt of the company to come up with the percentages in the capital structure. By multiplying these through, we end up with a weighted average cost of capital. So you can use this tool for the up to 9,000 companies that we have available in the database. Again, for more detail or to demo the site, simply click the Try Stockcalc Now button to access the site directly. Thank you for using Stockcalc.